Most people debate Roth versus traditional like one is smart and the other is dumb. But mathematically, that is not what is happening. You are not really choosing between two retirement accounts. You are choosing between two tax rates, pay tax now or pay tax later. And the entire decision can be compressed into one uncomfortable question. Are you willing to bet that your tax rate in retirement will be higher or lower than your tax rate today? Take a $10,000 pre-tax savings budget. If your current marginal tax rate is 24%, the Roth path pays tax first, invests $7,600, and after 30 years at 7%, ends at about $57,853. The traditional path invests the full $10,000 first, grows to $76,123, and then pays tax when the money comes out. If the future tax rate is also 24%, the after-tax value is $76,123 times 76%, which is $57,853. Exactly the same. Same money, same return, same time horizon, same tax rate, same result. The investment return did not decide the winner. The tax rate did. But if the future tax rate is 12%, traditional wins by about $9,100. If the future tax rate is 32%, Roth wins by about $6,100. So this is not a moral debate. It is not a vibes debate. It is a tax rate bet. And the trap is that your future tax rate is not just one number. It can include tax brackets, Social Security taxation, Medicare premium cliffs, required minimum distributions, state taxes, and behavior. That is what we are going to model. Let us define the two doors. With a traditional 401k, your contribution generally reduces your current federal taxable income. The money grows tax-deferred. When it comes out, withdrawals are generally taxed as ordinary income. But there is one detail people often miss. Pre-tax 401k deferrals avoid federal income tax today, but they are still included as wages for Social Security and Medicare tax. So this is an income tax deferral, not a complete payroll tax escape. With a Roth 401k, the contribution does not reduce current taxable income. You pay income tax now, but qualified Roth distributions can be excluded from gross income when the required rules are met, including the 5-year rule and a qualifying event, such as age 59 and a half. For 2026, the IRS employee deferral limit for 401k type plans is $2,4,500 for workers under 50. The IRA contribution limit is $7,500. Those numbers matter because the contribution limit is the same nominal dollar amount, whether you choose Roth or traditional. That one fact creates one of the biggest misunderstandings in the Roth versus traditional debate. But before we get there, we need the core equation. Let C be the amount of pre-tax income available to save. Let T now be your current marginal tax rate. Let T future be the tax rate you will pay when the money comes out. Let R be the annual return. And let N be the number of years. With Roth, you pay tax first. So the investable amount is C times 1 minus the current tax rate. Then it compounds. With traditional, you invest the full pre-tax amount first, then you pay tax later. Now divide Roth by traditional, the contribution cancels, the return cancels, the time horizon cancels. Which means, in the clean mathematical model, the Roth versus traditional decision is not about whether the market returns 5%, 7%, or 10%. It is about the tax rate you pay now versus the tax rate you pay later. If your future tax rate is higher than your current tax rate, Roth wins. If your future tax rate is lower than your current tax rate, traditional wins. If the tax rates are the same, they tie. That is the simple model. Now let us make it real. Assume you have $10,000 of pre-tax income available to save. Your current marginal tax rate is 24%. The money grows for 30 years at 7% per year. After 30 years, the growth factor is about 7.612. The Roth path pays the 24% tax now, so it invests $7,600. The traditional path invests the full $10,000, but the ending value depends on the future tax rate. At a 12% future tax rate, traditional wins. At 22%, traditional still wins, but by much less. At 24%, they tie. At 32%, Roth wins. At 37%, Roth wins by almost $10,000. Nothing about the market return changed. Only the future tax rate changed. That is the bet. But there is a problem with that sentence. It is too simple. Because in real life, your tax rate is not one number. When people say, I am in the 24% bracket, they often talk as if all their income is taxed at 24%. That is not how U.S. federal income tax brackets work. In 2026, the standard deduction is $16 to $100 for a single filer. The federal brackets then stack income into layers: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Take a single worker earning $130,000 in wages. Ignoring other deductions, after the $16,100 standard deduction, taxable income is $113,900. That puts the top dollars in the 24% bracket. Now suppose this person contributes the 2026 maximum employee deferral of $24,500 to a traditional 401k. Taxable income falls from $113,900 to $89,400. The federal income tax bill falls from about $19,934 to about $14,380. That is a tax reduction of $5,554. Notice what did not happen. The tax savings were not 24% times $20,400, which would be $5,880. $8,200 was removed from the 24% bracket, saving $1,968. The remaining $16,300 was removed from the 22% bracket, saving $3,586. Add them together, and you get $5,254. This is why real tax math is a staircase. A traditional contribution saves tax from the top down. A Roth contribution pays tax from the top down. So the first real question is not Roth or traditional. It is, what marginal bracket are my contribution dollars actually hitting today? Now look at the other side of the bet. In retirement, traditional withdrawals generally become taxable income, but they do not necessarily all get taxed at your old working age bracket. They fill the future tax ladder from the bottom. This is one reason traditional can be powerful. During your working years, a traditional contribution might avoid tax at your top marginal rate. Later, withdrawals may fill the standard deduction and lower brackets first. That creates bracket arbitrage. But there is no universal guarantee. Retirement income can come from pensions, Social Security, annuities, taxable investment income, rental income, part-time work, or large required distributions from pre-tax accounts. And if those income sources are already filling the lower brackets, the next traditional withdrawal may not be low tax. It may land in the same bracket, or a higher bracket. Or it may trigger something that does not look like a tax bracket at all. That is where the clean equation gets messy and more realistic. Here is a simplified example of a hidden tax rate. A single retiree receives $36,000 in annual Social Security benefits and withdraws $42,000 from a traditional IRA. For clarity, this example uses the base 2026 single standard deduction and ignores the existing age-based additional standard deduction and the temporary 2025 to 2028 enhanced senior deduction for eligible taxpayers age 65 and older. It is designed to isolate the Social Security inclusion mechanism, not to produce a complete tax return. Under IRS rules, Social Security taxation depends on a formula that includes half of Social Security benefits plus other income. Depending on the result, up to 50% or up to 85% of Social Security benefits can become taxable. In this example, half of $36,000 plus $42,000 equals $60,000. Using the IRS worksheet structure, the taxable Social Security benefit is about $26,600. That puts taxable income around $52,500 before age-based and enhanced senior deductions. But here's the strange part. While Social Security is still phasing into taxable income, $1 extra of IRA withdrawal can cause up to 85 cents of additional Social Security benefits to become taxable. So $1 extra of IRA withdrawal can create $1.85 of additional taxable income. If the next taxable dollar is in the 22% bracket, the effective federal tax impact can be 22% times 1.85 or 40.7%. This is sometimes called the Social Security tax torpedo. It does not mean Roth is automatically better. It does not mean traditional is bad. It means the future tax rate you are betting on may be an effective tax rate, not just the bracket printed on a tax table. That matters. There is another hidden piece, Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It is not officially an income tax bracket, but economically it can feel like one. For 2026, CMS lists the first Part B IRMAA threshold above $109,000 for single filers and above $218,000 for married couples filing jointly. In the first tier, the Part B adjustment is $81.20 per month, and the Part D adjustment is $14.50 per month. For a married couple where both spouses are enrolled in Part B and Part D, crossing that first IRMAA threshold can add $81.20 plus $14.50 times 2 people times 12 months, which equals $2,296.80 per year. The important part is not the exact example. The important part is the shape. This is not a smooth tax bracket. It is a cliff. A small increase in income can trigger a much larger increase in Medicare premiums. So when you compare Roth and traditional, the future rate may include income tax, Social Security taxation, Medicare premium cliffs, and state tax. That is why the simple equation is correct, but incomplete. Now, let us look at another nuance that makes online debates confusing. The 2026 401k employee deferral limit is $24,500 for workers under 50. That same nominal limit applies whether the contribution is Roth or traditional. At first, that sounds neutral. But it is not neutral if someone maxes the account. A max Roth contribution is $24,500 of after-tax money inside the retirement account. A max traditional contribution is $24,500 of pre-tax money inside the retirement account. Those are not economically identical unless we also account for the tax savings from the traditional contribution. Assume a 24% current tax rate. $24,500. Traditional contribution saves $5,880 in current federal income tax if all of it avoids the 24% bracket. A fair comparison must ask, what happens to that $5,880? If it is spent, Roth will often look better simply because more after-tax wealth was forced into the retirement wrapper. If it is invested in a taxable account, the result depends on taxes in that taxable account. And if it is invested with no tax drag at all, the pure math says the strategies tie when tax rates are equal. A max Roth contribution grows to $186,500 tax-free, assuming a qualified distribution. The traditional account grows to the same pre-tax amount, but after a 24% withdrawal tax, it becomes $141,740. The tax savings of $5,880, if invested separately for 30 years at 7%, grows to $44,760. Add that to the traditional after-tax account, and you get $186,500. Tie. But taxable accounts are not always tax-free. Long-term capital gains generally receive different tax treatment from ordinary income, and the rate depends on taxable income. If the side account is taxed at a 15% long-term capital gains rate only at the end, the sidecar falls from about $44,760 pre-tax to about $38,928 after-tax. Now, the traditional plus sidecar result is about $180,668. The Roth ends at $186,500. So Roth is not magically higher return. It is more tax-dense when contribution limits bind. A dollar inside a Roth account is an after-tax dollar. A dollar inside a traditional account is a pre-tax dollar. That difference matters most for people who are actually maxing the account. And according to Vanguard 2024 Workplace Plan data, only about 14% of participants reached the employee deferral limit, while Roth was offered by 86% of Vanguard plans and used by 18% of participants who had access to it. So for many people, the practical behavior question may matter as much as the theoretical tax question. Will the traditional tax savings actually be invested, or will they disappear into lifestyle spending? That is not a spreadsheet question. That is a human question. Traditional accounts also have a timing issue. Under current IRS rules, traditional IRAs generally require minimum distributions beginning after the year the owner reaches age 73. Employer plans, such as 401ks, have related required beginning date rules, with exceptions depending on employment status and plan rules. A required minimum distribution does not mean traditional was a mistake. It means tax deferral eventually turns into taxable income. For some retirees, that is fine. For others, forced income can interact with Social Security taxation, Medicare IRMAA, or state taxes. Roth accounts have different lifetime distribution treatment. Roth IRAs and designated Roth accounts in 401k and 403b plans generally do not require lifetime withdrawals while the owner is alive. Beneficiaries still have their own rules. That flexibility has value. But again, it is not free. The cost was paying tax up front. So the RMD question is really another version of the same question. Would you rather control the tax bill now or defer it and manage it later? There is one more variable that cannot be solved exactly: tax law risk. The IRS publishes historical tables of U.S. individual income tax rates going back to 1913, and the history is not a straight line. Tax brackets, deductions, exemptions, and top rates have changed many times. That does not mean taxes must rise. It does not mean taxes must fall. It means the future tax rate is uncertain. Roth reduces uncertainty on qualified withdrawals because the tax is paid up front under today's rules. Traditional preserves more cash flow today and leaves the future tax bill open. Neither side eliminates risk. They move the risk to a different point in time. And this is why the cleanest way to think about Roth versus traditional is not as a product choice. It is a tax timing contract. Roth says, I accept today's tax rate. Traditional says, I accept tomorrow's tax rate. So instead of asking, which is better, Roth or traditional, a better framework is 5 questions. Question 1. What tax rate am I avoiding today? Not your average tax rate, not total tax paid divided by income, the marginal rate on the dollars being contributed. Because traditional deductions save from the top of the bracket ladder down. Question 2. What tax rate might I pay later? Not just the printed bracket. The effective rate after Social Security taxation, Medicare premiums, state taxes, and other retirement income. Question 3. Will the traditional tax savings actually be invested? In pure math, traditional can match Roth when tax rates are equal, but only if the tax savings are saved and invested. If the tax savings are spent, the comparison changes. Question 4. Am I hitting contribution limits? When limits bind, Roth becomes more tax-dense because the same $20/40/500 limit can hold after-tax dollars instead of pre-tax dollars. But traditional plus an invested sidecar may still win if the future tax rate is much lower. Question 5. How much flexibility do I value? Roth can offer more control over taxable income later. Traditional can offer more current cash flow and potentially lower lifetime taxes if withdrawals land in lower brackets. The answer depends on the household, the tax code, and behavior. Some people split contributions between Roth and traditional. That is not because the math disappeared. It is because uncertainty exists. Splitting can be viewed as tax diversification, part of the portfolio taxed today, part taxed later. Not a universal recommendation, just a hedge against being wrong. Roth is not magic. Traditional is not a loophole. They are 2 sides of the same tax timing equation. With equal tax rates and equal savings behavior, they can produce the same result. But real life is not just an equation. Real life has brackets, contribution limits, Social Security taxation, Medicare cliffs, required distributions, state taxes, and human behavior. So the real Roth versus traditional question is not, which account is better? The real question is, which tax rate are you willing to bet on? The one you know today, or the one you might face decades from now? This video is for education only. Not financial advice, not tax advice. Just the math behind the decision.